Everyone, welcome and thank you for coming to our webinar today. I just want to make sure before we start, can everybody hear me? Can you please put in the chat whether or not you can hear us today? All right. Okay. So today we're going to be going over a new topic, and this topic was requested by popular opinion here. There's a lot of you that were asking about it, and it's actually our first time presenting on this topic. However, it's basically a lot of conversations that we have with our investors. So with that being said, today we're going to be going over why long-term rentals are better than short-term rentals. So some of you may be familiar with Marshall Reddick, and some of you, this might be your first time experiencing Marshall Reddick webinar or basically event that we have. So we're a full-service real estate firm, and we can be broken up into 4 divisions of our company. First is we are a real estate brokerage. So we help people buy and sell their homes, whether that be your primary or your investment property. Second division, which we'll be going over a lot today, is our property management. So we take care of everything for landlords, whether that be leasing, maintenance, renovations, rent collections, and everything that landlords need to do. That could be even collecting a check every month and dispersing back to you, and we'll further go over that. Third is we have our private lending. So we have a lot of borrowers that are seeking to utilize our private financing. Maybe you don't qualify for conventional financing, and so we're a good hard money alternative. And then that kind of breaks off into the 4th division of our company. So for those borrowers, they're borrowing from our either mortgage fund or private lenders. So with our mortgage fund, the same way that you can own real estate and collect rent checks, you can be an investor that owns mortgages and collect mortgage payments. With all this being said, here at Marshall Reddick, I'm an advisor as well as just a representative for our property management. So I'm also a licensed realtor here in California. I've been with Marshall Reddick for a couple years now, and I've had the opportunity to work in all 4 divisions of the company. And I also had the opportunity to work in accounting here, so I have had a good background and understanding of Marshall Reddick. I myself, I also invest in our mortgage fund after underwriting loans and being a part of it. It's something that was really exciting to me, and I'm glad to be able to be a part of that. With me today, we have Scott Pastel. Scott is the VP of Property Management and Real Estate here at Marshall Reddick. He's helped shape and form the company to be what it is today. He's had 18 years of experience in real estate, and he's been with Marshall Reddick for a long time now. He himself is a realtor, and he also is someone that practices what he preaches. He owns investment property. He owns property in California and many of our markets that we have. And he first started investing in 2008 and has had many successful investments since then. With that being said, I'm going to turn it over to you, Scott.
Thank you, Cameron. I really appreciate that introduction. You saw my smile just, as you very, generously, said some things about my past with Marshall Reddick. So great to see everybody on the webinar. Nice to see some familiar names and to meet many of you as well for the first time. I started working at Marshall Reddick in 2005. I've been here ever since. I learned pretty quickly the importance of both property management and location. My first investment property purchase was kind of in a unique time, as the market was starting to show a decline, sort of like I could see the beginning of what was the Great Recession. I did buy a property in a pretty flat market of Alabama, which I guess was a good thing at the time because the value didn't really drop a lot after that. but the value didn't go up much ever either. So Cameron, I sold that property in 2020 for the same price I bought it for in 2008, but that's my first property. And as I like to tell people, I never would have been able to go on to purchasing my second property, third property, and fourth property had I not, taken that first crack, in real estate investing. So thanks for the introduction. And folks, it's great to have you on the presentation. I just want to go back to this first slide for just a second. As we're about to speak here for another 45 minutes or so, I want to set the precedent for what this webinar is about. So we have the topic, and as Cameron mentioned, in our real estate and property management departments, this has been a pretty common conversation. It's become more and more and more of a common conversation on, when and if do short-term rentals make sense? What are the pros and cons versus long-term rentals? Our company, Marsh Riddick Real Estate, as of the end of June, manages just under 2,600 properties. I know the number, I look at the reports, so we were just a few shy of 2,600 units that we manage. These are in the 5 states that we operate in: California, Texas, Tennessee, Kentucky, and Florida. Later in the presentation, I'm going to go over the asset classes that we manage in residential real estate, but I wanted to set the precedence here for a second. So this presentation is geared towards investors that are looking at purchasing investment property, and they're not sure whether or not they should buy a property that's a short-term rental or a long-term rental. That is what this presentation is. If you are an individual that's owned a vacation property for many years, and let's say you own it in a Lake Tahoe for us out here in California, Jersey Shore, and for those in the East Coast, if you already own a vacation property and it's in a very, very, very high traffic vacation destination, then I'm not necessarily here to tell you that you should rent it long term. I'm going to make a lot of arguments and a lot of suggestions and data to show why it might make more sense. But this is geared towards those looking at buying investment properties and just wondering, should I buy short-term properties or long-term properties? So now that we've kind of got a good idea of the focus of the presentation, I just mentioned a minute ago, Marsh Riddick is in these 5 states. So we cover a large span of Southern California, Orange County, LA County, Riverside County. We're actually starting to slowly open up some parts of Northern San Diego, and we do have a small portfolio in Northern California. Many of you guys know we do have physical offices in New Braunfels, Texas, San Antonio, Austin, and Houston, as well as Clarksville, Nashville, Tennessee, and Cape Coral, Florida. So that is comprised right now of just under 2,600 units under management. We are a full-service, long-term residential management company. We have decided to do that, and that has been our focus. And obviously, a lot of our clients own long-term, some short-term. Some of our staff has, family vacation rentals. It's allowed here at Marshall Riddick. It's just something that over the years we've come to find long-term provides extensively more benefits with much less risk. So some of you folks that have traveled to our offices have had a chance to meet our teams. Just as I wanted to give you a good idea of kind of what the Marsh Riddick team and staff looks like. The top right, and then going clockwise, we're going to start with our Southern California office there. Most of these people in this slide are either realtors, leasing agents, property managers, maintenance managers, tenant coordinators. Probably about 80% of these individuals, maybe even 90%, work in our property management, leasing, and sales department. Specifically in California on the top right, we do have a lot of our administrative staff members. So we've got a lot of our private lending team there, our accounting team, our software development team. But if you do have the chance to visit any of our offices in Texas, Tennessee, and Florida, you'll have the opportunity to meet these individuals who are the ones that are basically just allowing us all to have a stable, profitable, low-risk investment. So bottom right is our New Braunfels, Texas team. along with a few people on our Austin, Texas team. In the middle at the bottom is our Cape Coral, Fort Myers, Florida office. Bottom left is our Clarksville, Tennessee team. And then the top left is our San Antonio office with our San Antonio, Texas team. So we are a one-stop shop. We provide consistency in not only the quality of service, but also the fee structure in all of our markets. So we have a few philosophies in property management. What makes us different? How do we view property management? First and foremost, we really look at ourselves as asset managers. Asset managers being that we look at the financial return of our investors, and we look at ways that we can help maximize income, lower expenses, and doing it in somewhat of a unique manner that's customized with the plan that the investor has in mind. So while some investors look at accelerating their portfolio and buying multiple properties over a period of time, some investors just want to start with one. Some investors want to, trade different types of properties between multifamily, single family. We put together, with the help of our advisors like Cameron, a plan that fits our investor, and then having, the experience of selling on average about 600 plus or minus properties a year to, hundreds of different investors. We have the ability to really help each client figure out what is their specific unique criteria that will help us accomplish their goals. So we view us and property management as partnered with our landlord. What that means is in our fee structure, we only make money when the landlord makes money. We don't make money when the landlord loses money. So you'll see that we don't charge fees during vacancy. We charge a percentage of the rent so that when the rent increases, everybody succeeds. So we found that unless the property manager and the owner are compensated the same, then it's hard to make sure everybody's goals are aligned. Now we get to number two. Obviously, there's a lot of trust involved. We're looking at, some of the largest investments that some of us have ever made. Rents going up, expenses, these things can add up. So we treat our properties that we manage as they are our own properties. And we like to have, just very transparent, open, honest conversations with our clients. We're big on educating our clients so they understand the reasoning behind our advice. Lastly, investment-minded managers. You're not just buying a house here. This isn't just a place to, call another property that you own, or this is for many of our and most of our clients is some of them their livelihood, some of them their retirement plan. Some of them are, looking at ways to maybe get out of working full time and just, living off of their investment properties. So we take that very seriously, and we want our clients to always have the financial gain that they're expecting, not just the first year, but the fifth year, the 10th year. So in some cases, our advisors might provide suggestions and feedback to make adjustments to properties, or even trading properties and exchanging properties in the future to make sure that we're always maximizing the return for our clients. So let's jump in here. So we'll get right into the topic. So I'm going to go through 12 reasons why long-term rentals make more sense as an investment than short-term rentals. So let's kind of go through some of these reasons. If you guys have questions, you can type them in the chat box. Most likely, we may not be able to get to all the questions at the end. However, Cameron is going to follow up with everybody one by one, offering a conversation on the phone or through Zoom video chat if you want, and we'll be able to answer any of your questions directly and open more conversation, provide more resources, and just be as much as a resource for you guys as we can. So right off the bat, right? So in long-term rentals, tenants bring all of their furniture. We usually recommend that the property comes with a refrigerator. If it's let's say 2-bedroom or larger, we recommend that it comes with washer dryer. That's a topic we can get into and ways to minimize the risk or the exposure to the owner. We do have ways to do that on the lease agreement. But the bottom line here is that obviously in short-term rentals, we have to furnish the property. And that can mean easily $20,000, $30,000, $40,000, depending on how big your property is, depending on whether you're in a luxury class property or A-class property. So right off the bat, there's a large expense and output right up front to furnishing that property. On top of that, there's the upkeep, right? The furniture will eventually have wear and tear, so owner would be responsible for the furniture, the furnishings, and I mean this can be easily over 100 different items in a property when you add up everything: desks, drawers, coffee tables, nightstands, and all the fixtures that come along with it. So I personally, I don't want to have to be kind of replacing all these things and spending all of that money, on the furniture, so that's going to be one of them right there. Okay, number 2, in long-term rentals, tenants are responsible for utilities. I like that one, especially if we have a tenant that's not very conscientious to, running the air conditioning at let's say 65 degrees or, not keeping the AC at a stable temperature. Or let's say just leaving water running, leaving a lot of lights on, or just basically using a lot of the utilities. I personally like the fact that in long-term rentals, tenants are responsible for paying their utilities. There's no volatility in the utilities for the owner because the tenants are responsible. Obviously, during a vacancy, owner's responsible for a very minimal amount of utilities because it's vacant. So, and then what I put on here is it can be very challenging to regulate the usage, and we can see just extremely high utilities during winter and summer seasons. So another expense that the owner is not responsible for in long-term rentals. Sure, and there are some multi-units that are older and they're not separately metered for water. We easily get around that, and we add a flat fee for any utilities that are not separately metered in the lease agreement. So what we would say is your rent is $2,000 plus, $150 a month for water. If there's not a separate meter, it's right there on the lease agreement. No problem. So we have ways to cover all expenses, even if utilities aren't separately metered. Number 3, and I actually, it's good to say here. Actually, I should have made this point in the beginning. These are not ordered in terms of importance. I didn't weigh them in importance. So we got just 12 random reasons in no particular order. Okay, so number 3, which is actually a big reason for me, is that in long-term rentals, we have stability and consistency in demand and income. With short-term rentals, we're going to see instability and volatility in our vacancy rates, in our rental amounts, and in just overall demand. So a good example in long-term rentals, what do we do when we have vacancies in December, during Christmas, during Thanksgiving? What do we do there, right? So in many cases, we will opt to try to sign a 16-month lease or an 18-month lease with a renter so that their lease expiration date now falls in the summer months instead of winter. And they may end up just renewing anyways, but there's ways that we can sign a slightly longer lease to get that expiration date to be in the hottest time, which is typically, the springtime to end of summer. However, the markets that we're in major metropolitan markets. We see year-round demand for long-term renters in all of our markets. So just basically having a lot of stability in the demand and not seeing major swings. 4 is another big one, another very, very big one, and maybe easily one of the biggest topics here is that owning short-term rentals is a job. It's employment. It's a job. Owning long-term rentals is a passive investment. Not every single rental property is passive 365 days of the year, but doing it correctly and positioning it correctly, you shouldn't have to be spending every day or even every week on all of your rental properties, right? If you are, something's not right there, right? If you have professional management and a good property manager, and a property that is open to a large majority of the rental market, then it should be pretty passive. Obviously, making sure the property is in good condition. There's a lot of ways to make long-term rentals passive. Owning a short-term rental, which is typically taxed on Schedule C, which is active ordinary income, we know we're going to be very hands-on, right? And we're going to have either nightly rentals or weekly rentals or monthly rentals. But obviously, like that person it's not their home, and there's just going to be a lot more action going on, and there's going to be more move-ins, move-outs, more questions from the strangers that are living there, a lot more focus and attention, and even like resources, right? Like moving the trash can in and out and scheduling house cleaners. So there's a lot more time that you would spend on a short-term rental property. So I have to look at the opportunity cost there, right? And I'm going to make a wager and say that like the amount of time that you would spend on, let's say, owning 5 short-term rental properties, you could spend that same amount of time owning, I would say, at least 20 long-term rental properties. I think there's probably like easily like a 4-to-1 ratio there, or maybe even 5-to-1 ratio as far as how much time you would spend on short-term. I think 5 is actually pretty fair. So if I'm able to own long-term rental properties and I'm spending a fraction of the amount of time on my investments, that frees up time to do other things. And who knows what I want to do, right? I want to get a full-time job, part-time job, other investments, right? So I have to factor in the fact that I'm going to be spending a significantly lower amount of time on my long-term properties that will allow me to go make money in other ways, right? Now, again, if I own, let's say, 5 rental properties, I'm full-time, I'm maxed out, I can't spend any more time on anything, right? If I look at the fact that if I owned, 10, 20 long-term rental properties, or let's just say enough rental properties that I still have enough time to work a job, invest in more properties, like I have to factor that in to whether or not it makes sense for me to do short-term or long-term, because I could make significantly more money with all that extra time. All right, so we like visuals here. This is a data source that came out in May of this year, excuse me. And all the rooms is the source. We're looking at 15 of some of the most highly sought after vacation destinations in the country. We're looking at the revenue, the average revenue per listing, and we're also seeing the change from May 2022 to May 2023. So what we're basically seeing are 15 large metropolitan cities that have seen a significant drop in the demand and a drop in the revenue. I would venture to say that these are not the only 15 cities in the country that have seen this type of volatility in the wrong direction. And that kind of stresses me out. I don't like to be very emotional in my investments, but that would certainly stress me out a lot. Probably why we have gotten so many phone calls in some of our territories on here, which is specifically like Austin, Texas, San Antonio, Texas, Nashville, Tennessee, even Cape Coral, Florida, which there's a couple in Florida close by on here. A lot of calls from short-term rental property owners that are looking to possibly convert their property to long-term. So I think just the volatility itself is it makes it hard to build a long-term portfolio of real estate without having to consistently make changes. Because really the fact is that the longer you own properties, the more it appreciates in value, the more rents increase, the more the principal pay down reduces. A lot of benefits there to owning properties for a long time. Hard to do that when you're seeing such volatility with your strategy. So we'll get back into numbers 5 through 8. So now this is a big one for me too. It's just wear and tear on my property, right? Now, if I rent my 3 or 4 bedroom home to a family of 3 to 5 people, how many people are going to be in and out of that property a year? Well, I'm sure they're going to have some guests. I'm sure they'll have some family, Christmas, Thanksgiving, different holidays, birthdays here and there, right? However, there's only, 2 people on the lease or 3 people on the lease, right? They cannot have unauthorized residents. In our lease agreements, any state lease agreement for long-term rentals will state that an occupant cannot be living in the property for longer than a specific amount of time. I want to say that date is somewhere between like 7 to 10 days in most of our leases. But you're going to have less people in and out of that property. I think it's safe to say when you own a short-term rental property, you're going to have a lot more people in and out of that property, equating to just more wear and tear. People that don't know how to use everything, people that are moving their stuff, furniture in and out, playing with appliances, and just really not as familiar with the house itself, but just a lot more people in and out. And maybe more parties too, right? I mean, in some short-term properties or in vacation properties, like there's obviously used for parties most of the time or half the time, versus like a family that would and might not want that kind of riffraff going on. So number 6 is liability. We have to look at liability. And we have to look at liability in the sense of what is the purpose of the property? What is the property being purposed for? So I think that this statement is not talked about. I don't think it's recognized very much, but it is a very, very true statement. And we know that because anytime we rent a property, which we rent, usually 30 to 40 or more a month in all of our offices, we get people who are not familiar with the home yet. And we know that we'll probably see more work orders and more maintenance requests in their first 30 days than we might see in their 4th, 5th, 6th, 7th, 8th, 9th, 10th month. They're figuring things out, right? Now imagine that happening every week, right? So in long-term rentals, our renters, they don't only call it home. It's actually their legal home. It's their primary address. It is now where their mail goes to, right? It is now where they are updating their primary residence for even maybe tax purposes or DMV purposes. This is their home. They don't own it, but it's their home. And there's sometimes a lot of sense of pride that comes from these renters that like the home and treat it as though it is their own home. But the usage and the unfamiliarity of short-term properties can often lead to problems and issues simply because of the lack of familiarity and experience with those people actually like using the home and living in it. So, okay, number 7. This is a fact. I was trying to think of just the right wording here, but if you have a property and it's in a residential community and it's not necessarily in like a vacation destination, like a lakefront property or like downtown in a large metropolitan market, if you're in more like a suburbs, a bedroom community, where a lot of the other properties are not being used for short-term rent, then it's likely you're going to have neighbors that get upset at you. People that don't know where to park and they park in the wrong spot and they park in front of someone else's house and they make loud noise because it's their vacation, or the purpose obviously could also be for non-vacation purposes. There's obviously short-term rentals that could be 30 days to 3 months, and maybe they're there for work. I think what it really comes down to is the people in that property changing, and maybe neighbors aren't really sure who's who, and occasionally there might be, people staying there that might not be as respectful as the last person. So that I think is just maybe not one of the top reasons, but if anybody lives near a house or property or condo or townhome that is used for short term, then you probably agree with what I'm saying. Number 8, okay, is definitely one of the top ones, is accountability, what we can legally enforce, and what we can hold tenants accountable to in short-term versus long-term properties. So in a long-term property, the tenants are signing a contract, and some of our leases are extremely long. Leases in our territories can be 20, 30 pages or more when you add up all of the addendums. The tenants they're signing and agreeing to a lot of terms that we can legally hold them accountable to. They're also paying a security deposit that we're legally allowed to hold until they move out. And we're then at that point able to make the necessary deductions on repairs and damages and things that the tenant breached in their legal binding contract. Not quite that same level of enforcement, not even close. And, there's another reason why I don't recommend rooms for rent either. It's a slightly different topic, but we don't see it too often, but there are some landlords that like renting individual rooms, which I am strongly against for all the similar reasons that we're talking about today. But you can't hold them legally accountable. They're not on a standard lease agreement. There's very easy ways for renters to avoid that type of liability because they're not signing the same legal binding contract as tenants in long-term do. Tenants in long-term are agreeing to abide by the HOA CC&Rs and rules and regulations. They're agreeing to abide, obviously, with the no smoking and the pet policies, but not bringing in unauthorized residents, and obviously maintaining the condition of the property, replacing air filters, and watering the plants, and on and on and on and on. There's a significant amount of terms that we hold the tenants accountable to in long-term rental properties, and they're putting up a much bigger deposit, usually 1 month's rent minimum or more. So there's more at stake for them, and it's easier for us to enforce things and hold them accountable when they break that contract. All right, so number 9, we got to look at if we're going to be hiring a property manager doing short-term rentals. So we should know that the average management fee is at least 20%. 20% to 25% is usually what I see, plus or minus. Average long-term, I put our fees are 7 to 8%. I've seen anything from like 7 to 10%, maybe even 6 to 10%. But you're looking at well under half or even possibly close to a third of the cost of property management. So we just got to factor that in to all of our income and expenses. But then we got to look at insurance because there's significantly more liability owning a short-term property. There's obviously higher insurance costs because we're now treating our property as a business. And it is not necessarily taxed the same either. And, this is important, I think, to speak to an accountant or CPA about if you're interested in the difference in taxes for passive income versus active ordinary and how short-term rentals are taxed, which I'll get into actually right after this one. But specifically for insurance costs, we have to insure all the belongings in the property, but the actual purpose of that property being short-term rent right off the bat will hike the cost for insurance. So the next one being income taxes, which I just mentioned, are taxed differently for short-term versus long-term, passive investment on long-term. And then the last one is just the changes in the laws in the local city regulations for HOA associations, for city and county local ordinances. We've seen a lot of changes in some cities and some major cities that have restricted the use of short-term rentals and have even required owners to petition and actually get on a list for a limited amount of properties that are designated as short-term rentals. So I know that I can rent my long-term properties for as long as I'm alive. I don't see why not. But I also do know that with short-term, there are pending law changes and pretty common law changes. Here in Southern California, there's been a lot of new laws in the San Diego ordinance for short-term rentals. Only 1% of properties in San Diego can be used for short-term rentals, except one specific city in Mission Beach, which is, definitely one of the hottest vacation destinations, which is allowing up to 30% of the properties to be used for short-term rentals. So it's just an example of changes that we're seeing in different places of the country, in different communities and cities that are creating just more standards and limitations for short-term rental. Okay, so hopefully that provides a lot of insight on understanding short-term rentals versus long-term rentals. Again, if you're looking at buying investment property, the whole premise of this presentation is to help you achieve financial independence by owning investment properties. So hopefully these points make sense to you guys. I'm just going to quickly recap what we went over in a more of a pros and cons sense, and just kind of summarizing, and then we're gonna segue into a different part of the presentation here in a few minutes. Some of the pros that I covered for long-term rentals: tenants paying the utilities, us not having to worry about that volatility. Long-term rentals just being having more stability for demand, stability in rent values, stability in occupancy rates, and obviously being a lot more hands-off. Opening up the possibility of a lot more time to own more properties, invest in other things, work a job, bring in income. Property management fees a lot lower insurance premiums, and last but definitely not least is a lot more accountability and things that we can enforce and hold the tenants accountable to. More pros. I know we went over this a lot already. Just kind of wanted to summarize it here. And at the very bottom there, one benefit that really is, it's hard to quantify, but in long-term rentals, people are treating their home like the property like it's their home, because it's not a hotel or a vacation property. So all right, lower. Now the cons, because it can't just be perfect, right? So let's look at what are the cons of owning long-term rental properties. So the one and obvious one is lower income potential, but that is also depending on the seasons and locations. Now the next one is you can't use it to stay and occupy when you're visiting that area. I would actually argue that the sole purpose of owning investment properties is not to occupy it. And if you're going to visit one of your rental properties, just stay in an Airbnb, stay in someone else's short-term rental property, and with all the income and cash flow that you're making, you can pay for an Airbnb and use it however you'd like, and not have to worry about all the other stuff that we just went over. Short-term rental property pros: higher income potential, again depending on the season and location. And the reverse of the con on the last slide is you can visit it and vacation it at any point really that you wanted throughout the year. Just keep in mind, when you are there, you're not receiving income, right? So what are you not getting when you're staying it? Money. So obviously something to keep in mind is that while you're there, you're not making money on it. Okay, just more summaries because I did go over a lot of this already. I think I'm going to jump to, we have the more cons. Obviously, I did cover this already. New renters not being as familiar, maybe reading instructions, not knowing how to use things. Which takes us to the bottom line of this part of the presentation that I just want to spend a minute on here. First and foremost, when does it make sense to own a short-term rental property? Based on all of this information, if you vacation somewhere pretty often, and I'm going to say multiple times a year, and you've decided that you want to buy a vacation property for you and your family or whoever else to stay in, and the sole reason to rent it out is just to supplement income while you're not there vacationing it, that's when this makes sense, in my opinion. And I don't know how many places in the country or the world that you vacation multiple times a year, but in my opinion, it may only make sense to own one of these. And if it's somewhere that you travel to repeatedly and several times throughout the year, and you just rent it out to supplement income when you're not there. I know I just said that twice. I just wanted to make that clear that is what this argument is saying, is when it makes sense to own a short-term rental property. Okay, now I'm going to cover the second, third, and fourth bullet point. And I want to ask everybody a question. And this is a real question that I want you to think about here for a minute. If you had to work 5 times harder or 5 times as much time to make 5 times the amount of money while having 5 times the amount of expenses, does it make sense? And I go back to scalability, right? And I go towards owning 5 short-term rentals should occupy the same amount of time as you owning 20 to 25 long-term rentals, right? So now I look at owning 5 short-term rentals versus owning 5 long-term rentals. Well, if I'm only spending 20% amount of the time on my 5 long-term rentals as I would on my 5 short-term rentals, again, that opens up the possibility of me to go out and do other things that bring in significantly more income. So I want everybody to think about that question, because none of these things are talked about in the glamorous world of, YouTube and the glitz and glamour of owning short-term properties. I'm just trying to provide realistic data and some good questions to think about. Doesn't necessarily make sense as an investment for all the reasons that we discussed. All right, so want to switch gears here for about 10 or 15 more minutes. Talk a little bit about what Marsh Reddick does manage, how we do property management. So our portfolio in each of our states are comprised of single unit properties, which are single families, condos, townhomes, up to multifamily properties and small apartment buildings up to about 20 units. I would say about 20% of our portfolio are apartment buildings, 5 units and up. I would say probably about 30 to 40% of our portfolio are multi-unit properties, 2 to 4 units. The other, 40, 50% being single unit properties. We do take vacant and occupied properties, but we heavily screen and underwrite the documentation for the lease agreements, addendums, move-in inspections, tenant ledgers, and we like to review all that before taking on tenant-occupied properties. So we do professional management, which is also called full-service property management. All of the things that you see here on the screen. So, we start from the very beginning and we look at a vacant property's condition and do what we call an onboarding inspection by having our maintenance manager walk a property and conduct a very thorough inspection when we take on a vacant property. That's ideal. We, of course, take on tenant-occupied properties, and we do also do onboard inspections of those properties, but they're with tenants and their furniture, and it's a little harder to check everything in that property. We try to check just the essentials and make sure there's no building code violations or lease violations when we do our onboard inspections of occupied properties. We handle repairs and maintenance. If we're taking on a vacant property, we'll do a thorough rental market analysis and provide the range from the low end to the high end of the market value. We take professional photos. We list our properties on all major websites. So our properties go on Zillow Group's list of websites of Zillow, Trulia, HotPads. We also list them on Realtor.com, Apartments.com, and about 20 to 30 other websites. We heavily screen the tenants on 5 main background checks. That's credit, income, criminal history, employment history, rental history, and we can go into deep detail on each one of those. But they have to pass our income requirement and provide us with their last 2 months pay stubs, last 2 months bank statements. We do call employers to verify employment. We call their current and previous landlords to figure out whether they, ever paid rent late, if they exceeded the security deposit and their move-out costs, if they kept the property in good condition, if they ever violated the lease agreement. We call it not just their current, but also their previous landlord. I just realized I skipped over a really important point in one of the past slides, but we also require our tenants to carry renter's insurance, which also decreases our exposure and our landlord's exposure by having liability coverage and personal property coverage for tenants when situations arise. We write the lease agreement, and like I said, there's a heavy amount of terms in there: early termination fees, insufficient funds fees, notice posting fees, late fees, you name it. Probably 15, 20 or more fees that we hold the tenant accountable to in our lease agreements. Now, we don't just go online and download a lease. We don't go on Rent Spree. We don't just, ask people on Facebook if they have a lease agreement we can use. We use the State Association of Realtors legal binding contract. And obviously, with our knowledge of the laws, we make sure that everything in there is legal. So collecting the rent, enforcing late fees, performing the ongoing maintenance of the property, providing our landlords with monthly and yearly statements for income and expenses, conducting annual inspections. So this is professional property management. This is the type of property management that can allow you to own 5, 10, 15 properties and scale a portfolio. This is the type of property management that all of us working here want, and many of us have on our rental properties. So just regarding maintenance, all of our maintenance is outsourced to third-party handyman contractors, plumbers, electricians, you name it. We have preferred vendors in each category. We have preferred vendors in each geographic location. So when there is maintenance, Marshall Reddick isn't receiving the income from that repair. That goes directly to the handyman or contractor that we work with. And all of the invoices and estimates are on the contractor's letterhead. So transparent, we want to make sure that our landlords know that we're trying to get them, the best pricing possible. But obviously, we have to work with professionals, in some cases needing licensing and insurance. So where you may have heard some horror stories in property management, I tend to see that a lot with companies that do maintenance in-house, have a major conflict of interest because they're making money when you're losing money, unlike our structure, which is only making money when you're making money. And in some cases, those companies will push for repairs and push for maintenance that might not be the most cost effective in most cases, where we do look at the most cost effective approach. We're not making the money on it. We want to solve the problem, and we want to solve it quickly, but we want to solve it for the long term so that our tenants have a good experience and our owners aren't, losing money on their investments. Kind of covered a lot of this already. I am going to hand it over to Cameron. We've got a little bit of a few more slides here in the presentation. Cameron is on the phone with new and experienced clients of ours every day and helping them figure out what types of properties make sense, explaining property management. So Cameron, I'll hand it back to you.
Yeah, of course. Thanks, Scott. Hey, guys, I'm going to quickly go through this here, but you might be thinking, where do I begin? Where do I start? Typically, this is where you would start with an advisor, sort of like myself, and we can go over your criteria and goals so we can help offer solutions and services to meet them. And some questions we might start with before narrowing down your criteria might be, why do you want to buy investment property? Why invest in real estate? I mean, you can buy stocks, bonds, mutual funds, and many other kind of investments. Just a short answer that, some people might throw out now is just it's good to buy hard assets and tangible assets to provide value, and it's a good place to park your money. For anyone that hasn't been to our website, I highly recommend going on it and taking a look and just browsing around, seeing some of our properties that we've handpicked for investors like yourselves. One thing that you'll notice when going and looking at these properties is that on all these properties, there'll be a property class there. So you'll see on the scale below that property classes start at luxury and go all the way down to D class. We like to focus on A to C class. You'll see that we have some luxury properties, but primarily A and B on our website. Different classes you'll find they offer different results. So you'll see that the higher the property class, the more appreciation, and as the class gets lower, you will see that the cash flow increases while appreciation might decrease. I think it's always good personally to go for a little bit of both. And that's where we see that A and B range. And not every market obviously offers that. California, for example, you'll see a lot more appreciation, where it might be harder to find a cash flow here in California. Of course, you will still be making a good return. It just might not be from cash flow. Instead, it'll probably come more from long-term appreciation. On the other hand, there's a lot of markets across the country, a lot of markets that we offer where you might see there's more ability for cash flow. Overall, you'll see that in general, the higher growth areas tend to be the higher property class areas. So when you look at specific investment criteria, it's important to ask a couple questions. Are you looking for income or long-term wealth? Are you looking for a potentially high cash flow property that might have more maintenance and vacancy, or maybe a more of a break-even cash flow with a high appreciation in a high appreciation market? What is your risk tolerance? When are you looking to retire? Maybe you might have a goal to purchase a property every year, every couple of years until you retire. How can you qualify for financing? How much experience do you have? And then what can you afford? Some markets might make more sense for investments financially than other markets. So when determining property class, it's important to understand the class. You need to understand the median home price. So this is based off of a MSA, which is a metropolitan statistical area, and this information we obtain through the National Association of Realtors. For easy numbers, an example of a median home price might be for MSA of $100,000. In that case, 100% would be $100,000. So when you're looking at it from $100,000 to $130,000, this would be considered A class. And then as you slowly move on, $100,000 to $80,000 would be B class, $80,000 to $50,000 C class, and then below $50,000 is D class. Similarly, underneath is the scale for multifamily. In multifamily, the price will go up as you add more doors, obviously, and so we factor this in by breaking down the cost to a per unit cost. So for easy numbers, again, a $200,000 duplex would be broken down to each unit being 100K, and this would be considered on our scale here at luxury class. So this here is a quick snapshot of our ebook. You can easily find it on our website, and you see the link here. And on our ebook, you might find pages similar to this one, and information that we just went over, and I'd highly recommend taking a look at it, especially when you're looking for your investment criteria. Okay, so when we're talking about classes here, some of the occupants and tenants you might see in the different classes, we kind of have broken here. This is also in our ebook. So when you're looking at luxury classes, you're going to be looking at executive business owners, and then A class, you're looking at professional, white collar. B class is more mid-managers, young adults. C classes, you're going to find your hourly employees, your blue collar workers, and then D class are some of your lower income and below the poverty line. And then things to us, I mean, in general, we want to provide the information, and this information is here to just set the right expectations. So things that are important when you're looking at, or when we factor in property classes, are price points. Something else that's important is the cost per square foot, school districts, and crime rates. Things that matter a little less might be whether it's a house, condo, apartment, maybe the property's age, the property size, or just the property condition. And so when you're looking at these different properties, there's the different tenants who are going to treat your properties differently. So a higher property class might have more cautious tenants. These tenants are going to have more experience and more knowledge with taking care of a house. They might have owned the property previously, and so they're more likely to do small things like use drain stoppers, or changing out filters regularly. Vacancy, you will find, is also lower on higher class properties, and a lot of times that's because they have multiple sources of income, or in general higher job stability. And taking that a step further, a property that might have started a rental amount of $1,200 can move to $1,600 with a couple rent increases, but they'll still be able to afford it, so you'll see less vacancy. Whereas in lower class properties, they might not be able to afford the rent increases, and so you might either not be able to increase the rent, or you'll see more vacancy when tenants move out because they can't afford it. So maintenance and vacancy, it's important to talk about. They're just a part of owning a rental property. So it's not a matter of if, but a matter of when you're going to have maintenance and vacancy. These are variable expenses, and the best that we can do is forecast them based on our past experiences and just general expectations that we have from working with investors in investment properties. So property classes also play a pretty big role in maintenance and vacancy. You'll see here that A class property has a lower maintenance and vacancy percentage, and then as you move down and head toward the C and D, you'll probably see the higher vacancies. And you'll see this represented in our calculators on our website as well. So here we're going to show you a vacancy example. This is vacancy is a little more complex to estimate, but basically what we do is we take a 365-day year and we times it by 8% to give you the days per year that you can estimate your property to be vacant. This is usually when a tenant moves out and we need to maybe fix up the property and then put it back on the market to lease it out to a new tenant. What we call in professional property management is we call this process a make ready. And the make ready process might just be some touch up paint, fixing a couple of cabinets, or maybe you have a property in great shape and it might not be much maintenance we need to do, so we can just put it right back on the market. Either way, during this time you will not be collecting rent, and we want to make sure to factor this into the vacancy. So this is something I would always recommend is to take a look at our reviews, whether that be through Google or Yelp, and don't just take it from us, take it from a lot of our clients and a lot of our customers, and get a firsthand witness of what other people say about Marsh-Reddick. You'll find that on all of our Yelp pages, we have over 4-star reviews, and we do take the time to respond to any inquiries or questions or comments that you'll find on our pages as well. Something else I would highly recommend is to take a look at our website. I know I mentioned it earlier, but I'd be happy to navigate with you on our website. But here you can just see some more of our property management services that Scott was talking about. If you go to marshallreddick.com, hover over services, and click on property management, down there you'll see management fees for each of the markets that we manage. If you go ahead and click on the market, you can click on up to 3 at once and just take a look at what those fees might be. They vary depending on the market, and it's just a good resource for you if you want to do some of your own research. So thank you so much for joining us tonight. I'm glad that you guys were here, and I would love to meet with each and every one of you. And for next steps, let's hop on a conference call. Let's hop on a video call. We can I can share my screen. We can go over some of our investment opportunities, and I'd love to find out more about your criterias. And with that being said, thank you guys so much for coming today.
Thank you, everybody. Thank you, Cameron. Thank you, folks. Really appreciate you. I know we went a little over, so those that wrote some questions, Cameron will be reaching out and open some conversation. You guys have Cameron's number, email, the last slide, website address for our property management. We look forward to open conversation, and we like conversing. I think it's just an important point is we like talking to you guys, hearing your questions, concerns, thoughts, ideas, goals. And us plugging all these resources, plans, and connecting you guys with your goals, and even just pointing you in the right direction. So thank you guys so much. We look forward to speaking to you again soon. Thank you.